Hi, in this video I will show you the total method and the marginal method, how to find the optimal price when you have the relation between price and sales units. First of all, you can see here that it's the normal price decrease, and you can decrease price to have more sales. The only situation where you are not a price setter, it's the perfect competition market. In this market, you're a price taker and the price is fixed. So you have to decide how much you want to produce or sell, but you cannot influence the price. But on all other markets, in this case it's a monopoly, but it doesn't matter. It's all other markets, then you have this relation. And you have here, as I said, price and sales, and then you have the unit cost. And in this case, it is like this, that every unit costs 4. And try to imagine that you are buying the things, not producing yourself, and your supplier tells you no matter how many units you are buying, you cannot have a discount, you cannot have any other prices than 4. Your price is always 4. So our variable cost is 4. Then in the total method, you have it here. We can calculate the revenue. It is the price multiplied by the number of units sold, of course. You can see here this multiplied by this gives you this, and the whole way through. This is your revenue or turnover. And then the cost of goods sold. It is the cost per unit and the number of units sold. It is 200 in this case. So the total variable cost is 800. And you can calculate the whole way through. And then you can find your contribution margin. It is, of course, your revenue minus your cost of goods sold. You can see here 2000 minus 800, it is 1200. And so it is the whole way through. Then you have the fixed cost. You are told that they're 500. Normally, we don't need to calculate this because if it is fixed, then you can maximize your contribution margin and it will be the same as your profit. But here they have the fixed cost as well, and then the total cost. And then you can calculate the total profit, because you can say total revenue, or let's say the contribution margin minus, let's take the total revenue minus the total cost. It will give you the profit. So if you see here 2000 in total revenue minus 1300 in total cost, it gives you 700. And if you look at this, you can see that the highest profit is at a price of 8. Then you will sell 400 units and you will have a profit of 1100. But you could as well have been looking at the contribution margin, because you also, of course, have the highest contribution margin here at 8, because you have only deducted the fixed cost and it's a fixed amount the whole way through. So here you can see after the total method, the highest profit and contribution margin is 1600. In a lot of assignments, they will not give you the fixed cost, and then you have only to calculate the contribution margin. Let's look at the marginal method. Here you have to calculate the marginal revenue, the extra revenue every time you sell one unit. And of course, the marginal cost here is 4, because every time you buy a new unit, your cost price is 4. So the marginal cost is 4 the whole way through. Let's see how to calculate the marginal revenue. You have here the increase in revenue, and you should divide by the increase in number of units sold. So here you have an increase of 2000 divided by an increase of 200. It is 10, and you can see the 10 here. And then you have here an increase in revenue of 1200 divided by the increase in sales, 200. So 1200 divided by 200 units, it's 6. And then you can calculate this the whole way through. And it is between the lines, because this marginal way of thinking, it is what happens if you go from this price to this price. Then the extra revenue will be 10 per unit and the extra cost will be 4 per unit. That means you have a contribution margin extra per unit, your marginal contribution margin, it is 6, the difference between these. And you can see you should continue to go to the next line as long as your marginal revenue is higher than your marginal cost. And you should continue from this line to this line because 6 is more than 4. You have a positive contribution margin. But if you go from this line to the next line, that means from a price of 8 to a price of 6, it's a bad idea because in this interval, the marginal revenue is only 2 and your marginal cost is 4. So don't do that. Go back and stay on this line. That means price of 8. And that is exactly what you also had on the total method. One thing that you have to realize, the marginal revenue is smaller than the price. Somehow you could say and think, how come that if I increase, let's say, my sales from 200 to 400 by decreasing price from 10 to 8, how come that my extra revenue per unit is only 6? Because the price for these extra units is 8. Yes, it's correct. But you had here, if you stayed here, you had 200 people who were willing to pay 10. But because you wanted to extend your number of units sold, you had to decrease the price from 10 to 8. So you had a loss. You had a gain because you have this extra 200 units and these extra customers paid 8. Yes, but because you decreased the price to your old customers as well, then you had a loss here. Therefore, your marginal revenue is not the price because you have a loss as well. So this is a mix of extra customers paying 8, but some of them you had a loss. So that's the reason that marginal revenue has the double slope related to the demand curve.